Hello and welcome to this November edition of Amundi's Market Review. In October, several equity indices registered a second consecutive month of losses. This reflects investors' disappointment in the lack of government spending measures to support economies and renewed worries on the spread of COVID-19. In the US, cases continue to spike, and in Europe, we are now in the middle of the second wave of the pandemic. Despite the speed and fear of propagation, the situation has not yet deteriorated to the extent of earlier this year. Governments, while reluctant, are progressively imposing restrictions and selective lockdowns. We expect the staggered relapse of economies with rolling restrictions, followed by recoveries led by policy interventions. The game changer will be the rapid development and wide distribution of safe and effective vaccines. We do not expect this to take place before the second half of next year. Therefore, the outlook remains uncertain and unstable. The duration of the pandemic will define the shape of the recovery. At this point, we believe the use and abuse of U, V, and other alphabetic letters to describe economic trajectories can be misleading. Rather, we expect an erratic growth profile in the short term and confirm our central scenario of a slow, uneven, and multi-speed recovery, depending on the country and sector. US and Eurozone GDP readings for the third quarter surprised us broadly on the upside. They confirm that a rebound from the economic collapse took place. The wider global engine of growth keeps ticking along, with China held the fifth plenum. Innovation, modern industry, and domestic demand expansions are the top priorities to articulate the path for China to reach a sustainable and more balanced growth path and a richer economy. The US awaits the results of its presidential election. The risk of vote contestations is on the cards, and market participants are preparing for higher volatility in the short term. Whoever is elected, January will be a period of adjustment in the transition to a new presidential term and a test of government cohesion. Looking at the market, the performance of the German Bund was higher than the Treasury in an environment of increased volatility both in the fixed income and equity spaces. Currency movements were more contained, with the US dollar getting stronger versus the euro, the yen, and in general emerging market currencies. In October, corporate spreads tightened across the full spectrum, especially in lower quality sectors. During the last week of the month, we saw an inversion in the direction of risk markets. Higher implied volatility for equity and negative sentiment led to the risk premium increasing on more risky, speculative grade bonds on both sides of the Atlantic, while higher quality bonds proved once again to be more resilient on the back of stronger support for the umbrella of central banks. WTI and Brent dropped more than 11% on demand concerns due to closing economic activity and outlook concerns. Conversely, gold remains resilient around $1880. Investors will continue to ask for more future policy boosters. The marketplace will still be that of central banks. After the correction in risky assets in the very last of October, the ECB committed to additional monetary stimulus for December. We will see if the Fed will repeat the cycle early in the first week of November. We have to deal with a shock that is temporary in nature, but cannot yet predict the timing of its reversal. We will continue to monitor high-frequency data such as mobility, electricity consumption, hotel bookings, as signposts for economic backdrop. For example, consumers' reaction to restrictions will be key. In the meanwhile, from an investment perspective, we will focus on diversification within our portfolios and selectivity of assets to counteract any possible higher volatility. Thank you for listening. Please keep safe and see you next month for another market review.